accessible for the majority of investors. Now, tokenizing these private assets could open them up to a greater accessibility to a wider range of investors, but at what cost? And I'm interested, Cynthia, perhaps if we start with you, how do you view this part of the market? How do you identify which private assets can and should even be tokenized in the first place?
It's a really important question to figure out where the demand is for those assets.
Puneet, from your perspective, where do you start? How do you look at this, the private sector and tokenizing it?
Yeah, we looked at this space over the last couple of years, and this is like if you think of private markets or make it broader as alts, it's a fairly big space. What kind of at least we found is the easier way to enter this is where there's least disruption and make it accessible, again, least disruption, but more immediate gate and quicker to market.
You mentioned private funds, and I'm just curious, where, again, as well as private funds, like what other assets should be tokenized first, I suppose? And Marcus, from your perspective, you obviously tokenized gold, but what do you make of how to narrow down where to start?
I think those are great points about the dichotomy between native asset tokenization and fund unit tokenization, and then within that, creation of a tokenized share class. I think with gold, though, it's interesting. If you cast your mind back 20 years, the vehicle that created some of the same benefits that blockchain and DLT creates, but in a different way, in that market was the advent of the gold ETF, which is 20 years ago that happened. Before that, you could buy a bar or a coin, or you could buy a mining stock, and that was it. And then, of course, the continuous IPO process and the ETFs came of age in the early 2000s. And they totally democratized gold investment. It meant you had a liquid venue, you had multiple APs and brokers were able to trade it, and you could effectively create a financial instrument 100% backed by the physical. But that was 20 years ago. So when we at IPMB looked at gold, we were trying to think, how do you create a next generation way of owning gold that brings unique benefits and efficiency gains using blockchain technology, but most crucially, creates a positive carry instrument instead of a negative carry instrument? Because if you think about gold, the critique of gold and some other asset classes, not so much private equity, private markets, but other commodities, is you have the up and down side of the asset class, but you have no yield or no return. And so if you can create a structure whereby through discounts and rewards, you effectively create a positive carry instrument, that's basically what we've done with IPMB with the binary token structure. So it's the only positive carry way of having 100% physically backed gold investment in the world, compared with all the platforms, all the ETFs, even the current token ecosystems are simple bar tokenizations. There are fees and an expense ratio, and you've now got a token backed by a bar, but you have no staking capability, you have no discounts or rewards. So I say that's the crucial difference with what we've done. And I think it takes me back to when you're using this technology, you've got to think about the business case first. It's not, it's not technology looking for a problem to solve. If you can, by using the technology, also create an alpha or an arbitrage in the traditional financial sense, as well as creating all the efficiency gains of tokenization, native or fund units. And that is, all the things we're talking about already: interoperability, reduced settlement cycles, reduced fees and costs, direct distribution, cutting out intermediaries. And there are already many examples of that. You've got Benji, you've got WisdomTree Prime, you've got Invenium in the States, very interesting platform. There are other platforms in London and America below the radar right now for private markets that will come out soon. So it's a fascinating area. But in gold, I think that was the key thing: try and create a positive carry asset with all the benefits of the traditional assets that are in the market today. And that's what we think we've done with IPMB.
A few things I want to pick up there, but starting with, you mentioned traditional assets. Like, why, Cynthia, from your perspective, like, why even work on tokenizing private assets why not start with publicly traded assets? Like, how do you think of the difference between the two?
Yeah. I think we start from the beginning of how do we set our priorities, and tokenizing a public equity I think the first question we have to ask ourselves is what's the additional utility that a client is going to get by buying a public equity on chain, and you compare that with what is the infrastructure necessary in order for that same client to access a tokenized public equity. Why would they want to go through that additional complexity on infrastructure?
You're nodding, yeah.
Just to add to that, also kind of interesting piece about private assets is that there are rules and restrictions at the investor level, and which doesn't really happen in the public markets. Anybody can access. In private markets, that's why this technology with wallets, which can define kind of what kind of investor it is, and smart contracts which are embedded within the asset itself, can actually do what we say complies by design. You can actually have the asset assess, is this wallet suitable or not, is it an accredited investor or not, etc., etc. So we think also the fact that this technology is pretty suitable for this particular use case, which has bespoke decisioning which is happening through the investment cycle.
Of private market tokenization, how do you assess it now? How have things changed, I guess, in the past year or so, where I think I'm right in saying that investment was pretty subdued post FTX, and now you've seen it sort of pick back up again?
Yeah, I mean, we've been actively investing across cycles, and actually in sort of more of the bear markets, you do see and understand that there are builders that are more dedicated, and so it's actually perhaps a preference to that time where that it's not sort of a tourist visit, but rather people that are dedicated to building in the space. I mean, in this area, there's a lot of interesting innovations. Obviously, the technology area is very new, but we're seeing innovations both from the infrastructure perspective, and that's predominantly where a lot of our investments are focused, but also in what the technology allows for opening up in terms of actually net new markets and investment areas. And I mean, this is permissionless peer-to-peer technology. So you have new markets that are evolving. We've been investing, for example, in DAO fund of funds, and this is sort of decentralized organizations where individuals can come together, new potential fund managers who are experts in their areas of innovation. And because of the nature of the technology being open, it's very efficient, low cost, and accessible for anyone to actually spin up new markets that might not have previously been possible because of the barriers to entry to someone who would want to create a market or a fund. And then on the technology side itself, in terms of like the infrastructure and what's been possible.
When it comes to tokenized gold, for example, like where is that demand coming from? Where are you seeing the most of that demand coming from?
Yes, well, we have plans across the waterfront at IPMB, but initially with the token ecosystem, I think it plays to a new ownership of gold using digital instruments. So, of course, you have to have a wallet to play, a digital custody wallet to play in that market. It appeals to those who want to own gold that way. So I think they're targeting more mass affluent, high net worth and retail to some degree, not in the UK, of course, but outside the UK. But also it appeals to the DeFi community because of the staking and rewards and being a positive carry instrument. But we're also working on institutional products as well, both TradFi and DeFi. And you can imagine, for example, an ETF with some of the same properties as the token ecosystem, i.e. an ETF with a return, would change the physical ETF market in gold, because today there is no physical ETF with a carry. So we're looking at lots of other products, and of course ultimately as the token ecosystem gets established, you could, in the mold of the Bitcoin ETFs, you could actually put those as collateral in funds and then launch the tokenized fund structure. And I don't know, many people in the audience may know my role before IPMB. I was SVP of Global Product for Digital at State Street, so I have a broad knowledge across the waterfront. So we are looking at TradFi and DeFi, but it does mean too, we've got the same problem as larger institutions. We've got to play to two stacks and two different investment communities, one with more governance and regulation currently than the other, although I think in the long run the two will move together. So that's the answer. But in the meantime, yes, we're building the token ecosystem first as a quasi-stable coin and payment solution, but it has the floor of that 1 gram of gold sitting behind the utility coin, which a lot of the other stable coins do not.
Cynthia, from your perspective.
So there's a few aspects of demand that we think are ultimately driving how we're looking at priorities, and the first of which is access. And so access to certain private assets, such as real estate, private equity, and private credit. There are a number of structures today that institutions and certain high net worth individuals get access to, but there are still some frictions associated with those structures, and this.
A lot of associated processes. There are legal agreements which need to be signed and agreed upon. Certain terms need to be agreed upon, which also currently is not very well defined. So while you tokenize the asset and kind of embed and get benefits out of that, there's need for an associated digitization layer to also come together with it for it to actually make a lot of sense.
Marcus, how do you navigate that? Like when it comes to the end investor, the whole, as Puneet was saying, that whole digitalization, the whole stream, how do you navigate that?
Specifically in gold or more generally?
Yeah, I guess.
I think that more prosaically for IPMB, we've used the Polygon chain, obviously because it's Ethereum layer 2, and so we have all the benefits of being able to bridge to Ethereum, but we also have the greater efficiency of Polygon. But obviously, we're taking a bet on that part of the digitization layer. But I do think you will find in the long run there'll be newer solutions in there to bridging. And I think wrapping is another technology that's coming, where you will be able to create some of this interoperability. And I think this is also crucial to the distribution side, because private equity is interesting, private markets, because on the face of it, it's one of the markets where the benefits of DLT and blockchain seem to be most applicable, because the internal and external inefficiencies of private equity are huge. If you're transferring bonds between a bond fund within a large bond manager, that can take a month. It should be done in hours or minutes. And externally, you have high distribution costs. Failed transaction rates are very high, 10%, 12%. You've got people doing manual reconciliations in banks. They shouldn't be doing that. You shouldn't have that level of failed transactions. And then you've got the whole debate we've had about, do you tokenize directly onto the blockchain or do you take fund units? The problem with some of that is regulatory. Some regulators won't allow you yet to natively tokenize, which is how you really liberate all the efficiency gains. But even when you've done all that and you've got different systems with different groups of clients running on different pools of liquidity, the problem is they're on different chains. So you're distributing on one chain or another chain, and it all depends who's on your team, as it were. So I think for me the solution ultimately comes down to a common domain model of understanding. As we heard earlier, it's not just the tech, you need a common processing understanding in process flows, and also legal ownership and legal transferability of the asset. And then if you can also create an asset exchange through interoperability, and you've got a liquidity exchange through stable coins that runs simultaneously, you hit the holy grail of being able to basically do T+0 on any asset, private market or public market, or payments, or gold. So that, to me, that's the holy grail, and we're headed in that direction. And I think Yuval's presentation was excellent on that this morning, and what Julia had to say about it was excellent. And the melding of public and private markets, that was very interesting too. I come from a TradFi background, so I've always thought private equities over there, derivatives are somewhere here, publicly listed securities are all over here, and they're completely different and unlinked together. Well, they're not. And I think this technology brings the opportunity to fuse them all together, and some of the clever POCs we've seen have done that. In private markets, for example, they've taken a private asset, they've tokenized it, they've exchanged it with another asset, they've used it in a collateral transaction by transferring it to another wallet, and they've calculated the lending on the asset using Aave or Avalanche. So far those are only POCs, but again, they're very interesting, because that's ultimately where you could take this level of digitization. And it's real business digitization. There's a yield, you've crushed the costs, you've just reduced the distribution costs, and you've got T+0 exchange of assets and T+0 exchange of value.
That's all very interesting. And I think that now might be a good time to see if the audience has any questions. I've got one over there. The mic can find its way. But before then, what shift from the experimentation phase to mass adoption of this?
Yeah, I find it hard to see if there's a single silver bullet or golden bullet. I don't see that. I think it's a process, and we are seeing it. But one thing I would point to is, I think there's a lot of digitization now going on behind the scenes. So I think we're out of the hype cycle on digital. We're in it in AI, and we will get into it in quantum. We're now in the adoption cycle in blockchain, I believe. And Gartner, I think, agrees with this. So for me, it's going to be, not only will you see more and more coalescing around business models and alliances and pooling of liquidity in collateral management, in payments and other areas, the more homogeneous classes, repo and treasuries. I think you're going to see obviously more development of interoperability solutions, as we discussed. But you're also seeing what I would call a class of digital propositions that are middleware services. So you may be surprised to learn there's certain things you're doing today in finance, and I found this out quite by accident recently, where the provider you're using isn't saying they're a digital organization at all, but they've implemented a blockchain tokenization solution, and it's now processing your transactions, and they're not even talking about it. They're internalizing the benefits on a huge scale and not talking about it. Yuval was talking about that to some degree in repo and in collateral management, trillions of dollars in assets, when most people think you haven't got $1 trillion in tokenized assets yet to work out. And the other one is some payment systems between TradFi banks. When you do an interbank payment on an app, they now tokenize all the information as you as the customer and the payment. So the only thing you have to put in is the amount. It goes through the tokenization system, the two banks on the same platform, middleware, lands in the other app. You don't even have to do anything. Whereas traditionally, you would have had to complete all your bank details in the two apps, process the payment in the traditional way. Still better than the old-fashioned way. So they're now using a tokenization platform to tokenize those cash transactions, and they're done in the
Behind the scenes.
Behind the scenes, yeah.
Question over there.
Really there, and Cynthia, you brought up the issue of standards, so that back offices can recognize these assets. So my question is, where do those standards come from? Who creates them and who manages them? Like where is that utility coming from to get to that holy grail that supposedly everyone wants?
Do you think retail investors will be able to access tokenized real-world assets? Will it be, for example, via Coinbase or a traditional trading account, or direct with the issuer? The impact on retail investors.
Well, I think one of the things that's interesting and exciting is that you have the option for both. Essentially, you have the open permissionless networks, which individuals are free to participate in, and then you can also choose to go through trusted providers, be that a crypto native exchange or through public markets or private market participants. And your traditional bank or broker as well. So it just opens up that world of possibility, and individuals can be free to choose what's most convenient.
I work for a private equity fund. I'm still not convinced about the benefit of tokenizing private equity assets. You already have private equity ETFs, platforms like Moonfair. It's an incredibly, as far as I know, energy inefficient technology to tokenize something, so I still don't understand. And if you have somebody like BlackRock acting as an intermediary, overseeing that the private equity assets they say what they say, by just going direct to the investor by tokenizing the asset.
By saying I think I would disagree with that view. I think several firms in the industry on the asset owner side disagree with that view because they've spent hundreds of millions of dollars building direct distribution platforms. Firstly, because they want to make the movement of the fund units more efficient internally. I won't name the client, but when I was at State Street, we were working on a private set of bond funds, a very large AUM, where the client told us when they have adjustments between the GP and the LP in the fund structure, it takes them 2 months to make the internal transfers between the funds. So they didn't even want to do direct distribution at that stage or crush the distribution fees. They simply wanted to make internal transfers between fund units more efficient and wanted an internal tokenization project. But I think when you then add the direct distribution, because a lot of big PE firms would like to fractionalize and they'd like to open the asset class up, whatever it is, commercial real estate, infrastructure, debt, shipping containers, whatever it is. They want you to be able to buy that for $1,000 and stick it in your wallet on your iPhone, rather than it going straight to a family office for a minimum of £500,000 allocation and being very illiquid. And they also want liquid secondaries, because that's the big issue now post the rate rise and the effect on private equity markets in multiple classes. You need more liquidity in the private market space. And I think if you're going to create a continuum of liquidity into publicly listed equities, again, tokenized assets really allows you to do that. I come back to this point where if you can create more asset efficiency using a distributed ledger and blockchain technology. And remember, most blockchain solutions, or nearly all, they're network solutions. Yes, they're blockchain solutions, but the other piece is if you have the immutable ledger. This is where I think regulators don't understand it. Properly regulated blockchain is a dream for regulators. Can you imagine any other technology where any asset you've ever dealt can be traced back to the inception, the genesis block of that asset, and then you can see every owner and every wallet has traveled through in the life of it. Think of that for a euro or a dollar or a pound. Regulators don't get it. All they need to do is be a node on that network, and they can see everything in a way they've never been able to see global financial transactions before. So that's just
Why do you think the convincing of regulators is taking? I mean, blockchain has been around for years, and so is crypto. Why do they not get it? Why has the convincing process not worked out?
That's a good question. I think you'd have to ask regulators. I think part of it is the origins of the technology. That's the other dichotomy we all